So it's a nice time we meet again for a session of advanced financial reporting. So this is your usual online lecture, that is CP Edwin Ochoy. So we are going to do a question of consolidation, whereby the parent acquired an associate and it acquired a joint venture. So, and this is the relevant question, which I will share on the other side so that we go through, so that we can be able to answer it correctly. So it was a question of June 2012. June 2012. It was a question of June 2012, question 1. So you can see there is June 2012, question 1. So they said that the following financial statements relates to the following financial statements relates to H Limited and its investee companies. Relates to H Limited and its investee companies. H Limited and its investment companies. S A Limited and J Limited for the end 30th April 2012. So that is what I mean, that the statement you are given is for the H and its investment companies. And its investment companies. So we can call it investee companies. And its investee companies, S Limited, A Limited, and J Limited for the end 30th April 2012. So these are relevant statements, income statement. We don't have to read these items. You know, it's just incomes and expenses. Then statement of financial position is assets and liabilities, including equity items. Additional information is my area of concern. The additional information is the area of concern. They are saying that H Limited acquired investments in the other companies as follows. He acquired the investments in other companies as follows. He acquired S Limited, he acquired A Limited and J. All of them, you can see they were acquired on this period. So they were giving us the period of acquisition. So this one is supposed to be, S was acquired on 1st May. That is 28, that is okay. This one is 209. And the other one was acquired in 2010. So that is fine. So they were acquired in those periods. So the shareholding, so the shareholding is 80%. That is 80%. Then 40% and 50%. So which means that S Limited was a subsidiary because it rises between the percentage of 51 to 100. A Limited is an associate because it rises between the percentage of 20 to 49. Then J is a joint venture. J is a joint venture because it rises exactly at the percentage of 50. Cost of purchase, or we call it cost of investment, or we call it purchase consideration, was 300, 200, and 250. Then revaluation reserve was 2015 and 20. Retained profit was 85, 150, and 120. So what you need to understand here is that it's only that they give you the date of acquisition, percentage of control, so that you know these investing companies are which types of companies. Are they subsidiaries? Are they joint ventures? Which is an associate? So that is why they give you the shareholding. Cost of purchase is all about purchase consideration. So if you add this purchase consideration, when they were investing in S, they invested 300. In A is 200, and in J is 250. Which figure are you getting? So 300 plus 200 plus 250. So that is 750. The total is 750.
Yeah.
So this cost of purchase, or I call it cost of investment, or I call it purchase consideration, is supposed to be the same, which we are given in the statement of financial position and an current assets as an investment. It's supposed to be the same because here it was just a direct acquisition. It was just a direct acquisition whereby hedge is the one which acquired S and J. So it means that hedge is the one which invested. Which means that hedge is the one which invested in those entities. So the investment in hedge is supposed to be the same, the one in which you have down there. So if we go up to the non-current asset here in this non-current asset, you can see we have this aspect of property, plant, and equipment. We have the property, plant, and equipment. Then we have intangible. We have intangible assets and investment. So you can see the investment. The investment is where? Under the parent only, which is 850. You can see the investment is 850. But down there we were having which figure? When we added the investment,
750.
it was 750. So there's a difference of
100.
There's a difference of 100. Why is this? Where is this difference of 100 coming from? Because it's supposed to be the same. I said that the hedge is the one which invested in these three entities. That is why you see the investment here is under the parent, which is hedge. Why is there a difference? So they said something in the additional information concerning this. So if you can see here, they say the hedge limited also invested in a half of the 10% loan stock in S limited. So H limited also invested in a half of the 10% loan stock in S. So we go to the 10% loan stock in S. So a half of that was part of the investment. A half of the 10%. So this 10%, a half of that. Remember S is this one, the 200. Half of 200 is 100. So that is what was bringing the difference. So a half of that also was part of the investment they made. And that is why you are getting the 100, which is the difference. Then additional information number 2, they say that the fair value of non-controlling interest in S was shilling 75 million on 1st May 2008. The fair value of non-controlling interest. So I said that when you compute something called goodwill, first, goodwill is an economic benefit expected from an asset. Goodwill is an economic benefit expected from an asset. So when you compute this goodwill, we say that goodwill is purchase consideration. You subtract the share of net assets acquired. Purchase consideration minus share of net assets acquired. So to know the methods to use in computation of goodwill, you need to know this, that when computing goodwill, you either use full method or use partial method. For you to use full method, you must be given the fair value of non-controlling interest. For you to use full method, I have said the NCI, the non-controlling interest must be measured at its fair value. The NCI must be measured at its fair value. Then the goodwill arising from the use of full method. Goodwill arising from the use of full method is attributable to the parent and to the non-controlling interest. And in the case of partial method now, for you to use partial method, NCI is not measured, will not be measured with its fair value. So which means that you will never have a statement of this kind. Like now statement under additional information number 2 will never be present. So when this statement is present, it implies that we are supposed to use full method in order to compute our goodwill. Whereby this full method, you get the goodwill attributable to the parent and to the non-controlling interest. So anyway, that is what this statement 2 implies, that when the fair value has been measured at its fair value, when the NCI, not the fair value, when the NCI, the non-controlling interest, has been measured at its fair value, we are supposed to use the full method. We are supposed to use the full method in the computation of the relevant goodwill. Number 3, during the year ended 30th April 2012, H Limited, this is H. So H Limited sold goods to S, and A as follows, sold goods to S, and A as follows. So you are given the selling price, profit margin, percentage in the stock at the year end. So H was transacting with S and A. So he sold goods right now to S at a selling price of 100, including a margin of 30%. But you can see by the end of the year, in the stock of S, these goods he received from H were not resold entirely. 50% of those goods were remaining in the stock. So the goods S received from H, which were working at a selling price of 100, whereby H included a profit margin of 30%. On the side of S, by the end of the year, he never resold these goods entirely. So which means that if we never resold the goods entire, out of the goods which are remaining now, the 50% of the goods are remaining in his stock. So which means that there's unrealized profit on the goods. There's unrealized profit on the goods, which we need to adjust. Because now you will find that the profit of the H is overstated. Because H now never realized everything concerning those goods. Because he never resold the entire goods. So we need to check the unrealized profit on those goods. We call it UPS, unrealized profit on stock. So that once we have that one, then I will adjust accordingly. The same with A, but now A is an associate. So we don't consider transactions with associates. They are non-group members. We only eliminate transactions which occurred between the parent and subsidiaries, which occurred between the parent and subsidiaries. Number 4, on 1st May 2010, H Limited sold S an item of plant for shillings 200 million. So this one was for shillings 200 million, reporting a 25% profit on initial cost. So they are saying that on 1st May 2010, H sold S an item of plant for shillings 200 million, reporting a 25 profit on initial cost of the initial cost of the plant. The group charges depreciation at 20% per annum on cost on plant. So the group charges depreciation at 20% per annum on cost on the plant, on cost on plant. So this one implies that H was selling an item of plant. Plant is a fixed asset to S. And what you need to know is that when there's intergroup sales of a fixed asset, the other entity which will receive that fixed asset will never resell. A fixed asset is not meant for resale. It's not like goods. For goods at least, you will find that the parent resold a portion of the goods, not the parent. The recipient of the goods resold a portion of the goods. Like now in this scenario, in note 3, when H was selling goods to S for 100, profit margin was 30. You can see at least the only percentage which was unsold by S by the end of the year was 50%, which means that 50% was already sold. So when H received the goods, when S received the goods from H, on the side of S, the only goods which he never resold is 50%. So I was trying to explain that for goods, at least a certain percentage of the goods which were in stock, you would find that the one which were initially received had been sold. Some of them will be sold. That is concerning goods. So it's only now we have to check for the nearest profit on stock on the remainder. That is a certain fraction. Like now, yes, just 50%. So the other 50% was sold. But for fixed assets, the other entity which will receive this fixed asset will never resell at all. A fixed asset is not meant for resale. That is why you can see a note 4, they are saying that H sold as an item of plant. Plant is a fixed asset, reporting a profit of 25% on the initial cost of the plant. They have not told you if S resold the plant, and they will never mention that. It's upon you to know that, obvious, S will never resell this fixed asset. So which means that S will never realize the profit which H realized, this 25% profit. Because now there's no way S will realize that profit because he will never resell the relevant fixed asset. So that is why when there's an intergroup sale or fixed asset, we need to compute something called unrealized profit on fixed asset. So we have to compute unrealized profit on fixed asset. Then they will say that the group charges depreciation at 20% per annum on cost on the plant. So which means that the group is the parent and all its subsidiaries. So if they mean that, when H was selling the asset to S, H has already subjected the plant to depreciation. Then when S received this fixed asset, again he charged depreciation. So both of them, they have charged depreciation on this asset. So which means that they have overstated the depreciation. They have done a depreciation overcharge. So again, that one must be computed and it will be adjusted accordingly. Number 5, all the goodwills of the 3 companies in which H Limited has invested are estimated to be impaired by 25% in the year ended 30th April 2012. No impairment losses have been reported in the past. So all the goodwill which we will get, which H will get, will be impaired by 25%. Included in the trade and other receivables and the trade and other payables are the following outstanding balances. are the following outstanding balances. So there was something from S, due from S to H, due from H, that is due from S to H. There was a 50 million due from A to H, then due from H to J. So this is, in short, this is all about outstanding amounts which have not been settled. There is this outstanding amount which has not been settled between the two entities. So what are we supposed to do? So if there is an outstanding amount which was never settled by the end of the year, that amount is obviously cancelled out. If there is any outstanding balance which is not settled by the end of the year, but only between the parent and the subsidiaries, between the parent and the subsidiaries. So if the parent and the subsidiary, there's something which is outstanding, something which has not been settled between the two of them, concerning, let's say, for example, a debt, something which was outstanding. So that amount is supposed to be cancelled out. It is not supposed to be carried forward to the next financial year. Like now, yeah, you know that the parent and the subsidiary is S and H. So there's this 50. That is the only thing I would consider. The others are just irrelevant. Because due from A is an associate. I think J was a joint venture. So that one we don't even consider. So due from A to H, due from H to J, those items are irrelevant. You don't eliminate transaction with associates and joint ventures. They are non-group members. So what I will cancel out is this 50. But now before I say it's 50, there's this statement which will disqualify that 50. So in this statement, they said in the books of S, the amount due to H was shown at 40 because H had sent a check of shillings 10, but H had not recorded the check. All the other balances were in agreement. What do they mean here? Rowan, how is Buzia this morning?
It is fine.
Yeah, so what does they mean in this statement?
There is cash in a transit, 10 million.
Yes, which means that the outstanding balance was the
There's no
outstanding.
outstanding.
There's this outstanding amount of 40. So if you say cash in transit is 10, where is the 40 going?
The first statement in the books of S Limited, the amount due. Okay.
Yes, was H.
Yes.
Was 40, yeah?
Yes.
Why is it 40, not 50? That is why they went ahead to give you that. 50
Yeah,
has
the
already
10 was in transit.
What am I supposed to do with the 40 and the 10?
Cash in transit, we add to receivables.
No, we add to cash. So what you do with the 40 and 10, remember that the 40 was outstanding, you cancel out. So when you cancel out an outstanding amount, you have to adjust your receivables account and the payable. Whereby I would subtract 40 under receivable and under payable. That is first the thing you have to do. To cancel out the 40, you minus under the receivables and under the payables. When I minus under the receivables, I have credited. When I minus under the payables, I have debited. I have cancelled out that outstanding amount. I can say in Swahili that awata Diana in the next financial year. Because hiyo deni imesaurika, si ndio? Yes. Kwa kuondoa kwa receivables na tunaondoa kwa payables. That is fine. What about this 10? 10 was paid. Again, when an amount has been paid, remember that it was an outstanding balance, so it was paid. but it was in transit. So again, we have to reduce the 10 under the receivables. Then this 10, it will be going to the recipient, whereby the recipient will add it to the bank, or it will increase his cash account. So what you do, you minus 40 under receivable and the 10. Then 10 you add it to bank.
Yes.
Then this 40 again, you reduce it under payables. That is what you are supposed to do in a simple way. Number 7, the group uses full goodwill. So this was not even necessary. This was not necessary. So this one, even if they could have removed this way, even if they could have removed that way, you need to know that when you are computing goodwill of the investee companies, like now the subsidiary, obvious for you to use the full method, you must be given the fair value of non-controlling interest. See, the examiner gave you the fair value. So when you have this statement here, obvious, you know that you would be using the full method. So it was not a must that they give you the statement that you are supposed to use the full method. Anyway, it's fine. So they say that the group uses full goodwill method and a proportionate consolidation as per IAS 31. So all dividends and interest had been paid by the end of the year. So we'll check on that if they were paid. So what the examiner needs is the consolidated income statement and the consolidated statement of financial position. So that question is now okay. It has been adjusted accordingly. Everything is perfect. So we can be able now to start with an income statement as we check if we will be able to finish. So what I'm supposed to do, remember that is concerning H. So H limited, consolidated. So we have consolidated income statement. So for the year, so our books is for the year ended. That is 30th April 2012. So we always start from revenue. So for the revenue, parent plus subsidiary. So anyway, before this, there's something I could have started with so that we check accordingly if the subsidiaries was existing for the entire year. So I could have started this with this structure and shareholding. So I could have started with this structure and shareholding. So the structure and shareholding. So remember that it was H which acquired 3 entities. So this is what you first start with. He acquired S, A, and J. So S was controlled up to 80%. This one was controlled up to 40%. And the other one was controlled up to 50%. So you know that this is a subsidiary, this is an associate, this is a joint venture. Then you draw a line in order to determine if the subsidiaries or investee companies were existing for the full financial year. Our financial year ends on 30th April 2012. So it means it starts on 1st May. It starts on 1st May 2011. And you know that S was acquired on 2/8. That is according to the additional information. This one was acquired 2009, and this one was acquired 2010. And all of them, it was May. So which means that This one implies that all of these entities in the current year, they were present for the entire period. Because now, like S was acquired 1st May 2008, that is 2008. So it was acquired in a previous year, previous periods, around 2 years ago, even not 3. The same with A. A was acquired 2009, 1st May 2009. H was, that is a H acquired J 2010, 1st May 2010. So it means in the current year, they were present for the entire period. So in the previous year, they have been preparing their statements. They have been preparing their consolidated statements. So what you are given is the statement for the current year, starting 1st May 2011, ending 30th April 2012. So which means that for the current year now, the year 1st May 2011 to 30th April 2012, you have to consolidate. You have to consolidate these investee companies, which means that the hedge will consolidate these investee companies for the entire period. So if they could have been acquired during the year, is when we consider from the time they were existing to the end of the year. But now this one were there for the entire year. The same thing I need to disqualify from your mind is that someone will say that, like now, if J was acquired 1st May 2010, so from 1st May 2010 to 2012, those are 2 years. Someone will say that I have to multiply my transactions of J with 2 years. That is incorrect. That is not correct. So in the previous years, they had already prepared their own statements. In the previous year, their statements were prepared. So the only thing you are doing is the preparation of the statement for the current year, for just 1 year, which is starting 1st May 2011 to 30th April 2012. So for revenue, I can see the parent was 1200 plus 1600 plus 600, no 16. Parent plus subsidiary. Parent plus subsidiary. So this is what I will be doing here. So if the revenue, I have taken 12 plus 600, cost of sales, 650 plus 250. So I will be adding the parent plus subsidiary. Then after doing that, we make the relevant adjustment. Then for the associates and the joint ventures, I will consider just few items. Like now, after this associate or joint venture, we will pay tax. Like now, after they will pay tax and they will remain with a profit after tax. Like now here, profit after tax of 71. The parent will requisition his share. The same with this one. After the parent will pay tax and he has a profit after tax of 111, the parent will requisition his share. So anyway, let's start. So most of the transactions I will be adding between the parent and the subsidiary. Right now I've taken the parent plus the subsidiary. Then under the revenue, you only adjust, you only subtract intergroup sales. And the intergroup sales you subtract must be between the parent and the subsidiaries. And it must have occurred in the current year under consideration, which means the current year when we are preparing our books. So the only intergroup sales which occurred between the parent and the subsidiary was this node 3, where H sold goods to S and A. But A is an associate, so we don't have to consider A. So the only intergroup sales I have here is 100. This 100, the selling price. So that is the only thing I have to subtract under revenue. There is no another intergroup sales. Then after that, I have to move to the cost of sales. So cost of sales, again, parent plus subsidiaries. So 650 plus 250. So 650 plus 250. Then you minus the same intergroup sales. You add UPS. Add UPS on closing stock. So UPS on closing stock, you add. Then UPS on opening. UPS on opening stock, you subtract. So this one is added. This one you raise. So UPS is all about out of these goods. Now the entity which received these goods, did he resell all the goods? So you take the unsold goods times profit margin. Unsold goods times the profit margin. So you go to the aspect where these goods were sold. So you take the one which received them. Right now, it was between H and S. Did S sold the entire goods of 100? We were told 50% were in stock by the year end. In this statement here, percentage in stock at year end, 50. Profit margin, you are given 30. Selling price is that one. So unsold goods is 50% of, so the 50% of this 100, 50% of selling price, 10 times margin of 30%. So unsold goods is 50% of the 100. So it's 50% of the 100. So that you multiply a margin of 30%. A margin of 30%. If you are given markup, you change to margin. So this is all about 15. So what you add here is 15. That is UPS on closing, because these goods were unsold by the year end. So that is UPS on closing stock. If there was UPS on opening, we could have subtracted here. But there was none. Because now there's no transactions of goods which were sold in the last financial year, at the end of the last financial year, which could be an opening. So if they could have been the same transaction which occurred in the last financial year, at the end of the last financial year, we could have done the same. We determine an nearest profit on stock, and that one would be our opening UPS. Then you talk about depreciation. So I've said here you minus UPS opening stock. So UPS opening stock. Then you add a depreciation undercharge. So depreciation undercharge is due to revaluation. Depreciation undercharge is due to revaluation. It's due to revaluation gain. And the revaluation gain is the difference between the fair value of an asset. So it's the difference between the fair value of an asset and its book value. So fair value of an asset and its book value. Or they call it market value, and this one is carrying amount. So the difference between the two. Or in order to get the revaluation, they always say that, for example, the fair value was in excess of the book value by a certain amount. So that is again the difference between the fair value and the book value. Obviously, the book value will be higher. Not the book value, the fair value would be higher. The fair value would be higher than the book value. So they would, for example, tell you that the fair value of the assets of, for example, S were in excess of its book value, or were in excess of its carrying amount by a certain amount. Or they will say that the book value will be below the fair value. book value is obvious below. Book value is below the fair value, again by a certain amount. So there was no statement of that kind in this question of ours. So once you have revaluation, I said it leads to depreciation under charge. It leads to depreciation under charge because now the aspect of revaluation gain, that element of revaluation gain on the asset had not been subjected to depreciation. That is why we would say that they undercharged depreciation. That amount by which the asset increased, that element of increase was never subjected to depreciation. So we need to subject it to depreciation. So you either take revaluation, you multiply with the rate, that is depreciation rate, or you take that revaluation, you take the revaluation, you divide with the useful life. You divide with the useful life. That is fine. There was no revaluation. So another thing you need to subtract is depreciation overcharge. So depreciation overcharge is due to the sale of fixed asset. Is due to the sale of fixed asset. And the fixed asset will give us two things. And here is profit on fixed asset. So in order to get this, you must have a set of fixed assets. So when there's a set of fixed assets by one entity to the other one, from one entity to another. So the other entity which received the asset will never resell it. So if the other entity which received the asset will never resell, it means that it will never realize the profit. That is why we compute and realize profit on fixed asset. I will take the transfer value times profit margin. Times the profit margin. The transfer value times profit margin. So the value at which the asset was transferred times the profit margin. So like now, there was that statement whereby we have a plant which was sold. That is according to additional information number 4. Plant is a fixed asset. They say that on 1st May 2010, H Limited sold S, an item of plant, for shillings 200 million, reporting a 25 profit on initial cost of the plant. The group charges depreciation at 20% per annum on cost on plant. So when H was selling this asset to S, it included a profit of 25%. But they never said that if S resold. So obvious, fixed asset is not meant for resale. So which means that when S received, it will never resell it. So we have to check the unrealized profit on each side. So there's a profit you will never realize because you will never resell that asset. So we check the transfer value. So the transfer value is 200 times the profit margin. So here you have 25% on initial cost. When they say on initial cost, this means this is markup. Profit on cost is markup. So which means I need to change to margin, that 25%. So first, this is 200 transfer value times margin. So if 25% is markup, so this is like a quarter. So margin will be a quarter plus 1. So that is a fifth. So you add the numerator to the denominator. So 200 divided by 5 is? So 200 divided by 5.
40.
That is 40. So that is unrealized profit on fixed asset. Then, due to this sale of fixed asset again, you need to determine depreciation overcharge. Because obviously they would say that when H was selling these goods to S, both of them, they charge depreciation. That is why they say the group. Group is this parent and the subsidiary. So both of them, they subjected this plant to depreciation. So which means that they overstated depreciation. That is what I call depreciation overcharge. Since both of them charge depreciation on this asset. So which I will take. So depreciation overcharge, you take the UPFA you have times depreciation rate times the depreciation rate. So UPFA is 40. Depreciation rate, you are told in that statement 4 was 20%. So you get 8. So 8 is what you subtract there. And it means that all the adjustments which you are supposed to make in cost of sales, you are done with them. So under cost of sales, you minus intergroup sales, you add UPS on closing to stock, you minus UPS on opening stock, you add depreciation under charge, which is due to revaluation, then you minus depreciation overcharge, which is due to sale of fixed assets. So when you compute the two, you are supposed to get a gross profit. You get a gross profit. Then after that, I can see in my statement there's investment income. So these items I'm picking direct the way they are from the income statement. So the one you see, I take parent plus subsidiary. Those are the ones I take direct from this statement. We just add parent plus subsidiary. Investment income for the parent and subsidiary is 85 and 2. 85 and the 2. So what I'm supposed to subtract now here is concerning two things. If the investing companies paid dividends or interest, if they paid, if the investing companies paid the dividends or they paid interest, you have to subtract from investment income. Because now if the investing companies paid that dividends, remember the parent had already recorded that dividend as income on his side. So if again the investing company, I mean those companies which are acquired by the parent, if they paid dividends and interest, the parent recognizes this amount as income during the year. That is wrong. The parent is not supposed to do that. The parent is entitled to a profit at the end of the year. So if they paid dividends and interest to the parent during the year, obviously we will say that the parent recognizes this as an investment income, as an income. So we have to deduct those dividends which were paid by investing companies and that interest which was paid by the investing company, so that we get the correct investment. So which means that S, A, and J paid dividends, and that one comes after the profit after tax. So you can see here, like now S paid 50, A paid 30, and this one paid 40. So this one you have to subtract, but with the share of control, with the parent controls them. So I would take 80% of 50, 40% of 30, and 50% of 40. So you say minus, so 50% of, not 50%, but 80% of 50. That is for the dividends which were paid by the subsidiary to the parent, minus, we have 40% of 30, because these are the dividends which were paid by the associate to the parent, and we have 50% of 40. So these are the dividends which were paid by the joint venture to the parent. So the parent had already recognized as an income. So we subtract. So those are the dividends. So these three are the dividends. So the last one is concerning interest. Remember, interest was 10% times 200 times a half. So where am I getting that 10% from? So they said there was an investment they made. And remember, if you made an investment in a loan, the return you get is interest. So they said that here, in addition information number 1, H also invested in a half of the 10% loan stock in S. And the 10% loan stock in S is this one, 200. So I have in a half of this. So a half of this is 100. So to get the interest which they were getting in return is on the 10%. And that was the only challenging part, because the others is just direct, like distribution. Distribution is just direct. You add the parent plus subsidiary, 100 plus 40. For the admin, we have 120 plus 90. Then for impairment, you introduce. So impairment laws needs are working. Impairment laws needs are working. So what you can realize here is that I have taken distribution, admin is okay. So there's this finance cost. Before I record this finance cost, you can see there's one expense which I've introduced, which is not here. We call it impairment. So impairment comes in when we do what, Rowan? Impairment comes in when we do what?
When we calculate goodwill.
Yeah, so once we calculate goodwill, it will be working. We have to impair that goodwill.
Yes.
Yeah, so that when we impair that goodwill, we can be able to get impairment. And the impairment is an expense, of which net goodwill after impairment is an asset. So that is why I'm introducing impairment, which was not there. So that I would say profit before interest and tax. Profit before interest and tax. So tax is concerning finance cost. So the finance cost is the one which is given again. It was 40 plus 20, you minus 10. 10 was this interest again. The one concerning the investment they made in the 10% loan stock in S, in the half of the 10% loan stock in S. Before I minus tax, because now I'm supposed to say profit before tax, but before now I say that there's an income the parent is supposed to receive from an associate and joint venture. Remember that what I've been doing is just taking the parent plus subsidiaries. The only point where I have considered associates or joint venture is where I subtracted the dividends they paid. The dividends they paid. And another point whereby I have considered the joint venture or associate, where I would consider and we have not considered, is concerning the impairment. For the impairment, you have to consider both of them. Then now the third place where I have to consider this associate or joint venture is whereby the parent he has to receive a certain income from them. So after these associates and the joint ventures, after these associates and joint ventures, I've paid tax. So we're going to profit after tax of 71 and 111. So this and this. So the parent will requisition his share. From the 71, the parent will require to receive 40% of that amount. Then from 111, he will requisition 50%. Because now that will be his income after these entities have paid their tax. So I will say share of profit after tax in associate and the share of profit after tax. So the first one is share of associate, share of associate, profit after tax. So remember that this was 40%. So 40% of 71, 40% of 71. And the other one is share of joint venture profit after tax. So share of joint venture profit after tax. So that is 50% of 111. So that here I will say profit before tax. I'm saying profit before tax because we have not considered the tax of the parent and that of the subsidiary. So raise tax. So the tax I have to raise here is only for the parent of 60 and that of the subsidiary. Because for the associates and joint ventures, we had already considered the tax. Because we took the profit, that is the parent took the profit after those two entities had paid tax. So after that, we get a profit after tax. We get a profit after tax, so that now the parent will be sharing a certain profit to the NCI and to the joint, to the not to the joint, but only to the NCI. To the NCI. So anyway, so we get profit after tax, profit after tax. So once I have the profit after tax, then now the parent will share some profit to the NCI, profit attributable to NCI. So that the balance will be remaining now to the parent, profit attributable to parent. Just feed the information from the start. Revenue. I think Elizabeth, we are together.
Yeah, we are.
All right, so the revenue.
1700.
1700. Cost of sales.
807.
So that is 807. So if you subtract the two, 1700 minus answer.
893.
So this is 893. Then investment income, after you have subtracted now the dividends and interest which was paid by investee companies.
5.
So that is 5. So this is 140. 120 plus 90, that is 210.
210.
So we have this one missing. We have to do a working rate impairment, so that even this one we get it later. So 40 plus 20 is 60. 60 minus 10 is 50. So 40% of 71 is 28.4. 50% of this one is 55.5. So that we get profit after profit before tax. So that we raise tax of 110. So up to that point, I think we have done the necessary and what we can be able to do direct without struggling. So another thing we have to check is now to compute the relevant goodwill so that we can get impairment, so that we can get the question is complete. So let us compute goodwill. So goodwill is all about purchase consideration you minus the share of net assets. That is the share of net assets acquired. So to make it very simple, I will start with the share of net assets. I want to make it simpler. So this is our working I will start with. Then I will do goodwill later. So I need to get the net assets, block figures. So I need to get the block figures of S, A, and J. So we have ordinary share capital, share premium. In this question, we have revaluation reserve. And we have retained earnings. We have the 3. So of which our ordinary share capital, remember that the ordinary share capital we just speak is for the relevant investee companies. So like S, A, and J. So in order to get the investee company, the net assets of the investee companies, you go to the equity part of this question. So we have ordinary share capital, share premium, revaluation reserve, and retained profit. So you just copy from here. So the only thing which you have to use as acquisition date is this one. So revaluation reserve and retained profit, when you are doing goodwill, the figure you always use is as the one which are given as acquisition date. So like now when I mean acquisition date, I mean that when there's a background noise, so mute your mic. So I was saying that for the ordinary share capital, share premium, revaluation reserve, and retained profit, so that is fine. So ordinary share capital and share premium, you pick direct. For S, I can see it's 200 to 50. This is 200 and the 50, not 250. It's 250 and 250. Then we have 200 and 100. But now for revaluation reserve and retained profit, you don't have to pick this one, which are in this statement. You pick the revaluation reserve and retained profit, which was present. Like now, when S was acquired, revaluation reserve was which figure? Retained profit the same. So that is why they went ahead to give you those information. It's not in additional information number 1. It's given here. Because as at the time of acquisition, it was May 2008, 2009, and 2010. That is when S, A, and J were acquired. So the revaluation reserves is 2015 and 70, 85, 150, and 120. So that is what you record as revaluation reserve and retained profit as at the time of acquisition. And that is what you need to know, that when computing goodwill, you have to use the retained earnings and revaluation reserve, which was given as at the time that investee companies were acquired. But for the others, this was 200, you just copy direct. This was 200, and this one was 200. This one was 50 from the statement. This one is 50, and this is 100. So these two, revaluation reserve and retained earnings, as acquisition date, as given, this is 20, 15, 20. This is 85, as given, 150, 120. So I need to get the totals here. So that is 355. So the second one is
415.
then the third one,
440.
all right. So this was just I needed to make it simpler. So this is not how you compute. This is just I was getting these block figures for the S, A, and J, so that I just compute in a simpler way. So I will compute now goodwill. Now this is how you compute goodwill. I could have done it one by one, but I needed to make it more simpler. So goodwill of S. So goodwill of S, use full method. Because already you have what? You are given the fair value of the non-controlling interest in S. So we have said is purchase consideration minus share of net assets. So purchase consideration was 300. What about fair value of NCI? So fair value of NCI was, to make it full, it was 75. So let me display that. So the 300 for the purchase consideration, I mean the amount H paid when he was acquiring S. So this is my purchase consideration. Cost of purchase, they call it that. When S was acquired, the cost of purchase was 300. That is the purchase consideration. So I said, in order to be full method, you must be given the fair value. Remember that we are given the fair value of non-controlling interest in S of 75. So this is what I'm recording as fair value of non-controlling interest in S. And that is what makes it a full method, whereby the goodwill will be attributable. The goodwill will be attributable to the parent, what we get here, and this column is for the NCI. Then I have to raise net assets because I said it's purchase consideration minus share of net assets. So the share of net assets, net assets already we have a block figure for S, 355. And it was an 80% controlled subsidiary. So 80% of 355 is, and 20%. 20% is for the NCI to make it 100. The percentage which was unacquired in S is 20%. That is the NCI. So the first one is 284, and the 20%, that is 71.
Yeah, 71.
So if you subtract, this is 4, this is 16. Yeah. So goodwill. So total goodwill here is, so you add the two, 20. So you do impairment of the same. So impairment, so it was impaired by 25%. That is what they say. Any goodwill arising from the investee company was impaired by 25%. They said it in additional information number 5. All goodwill of the three companies in which H has invested are estimated to be impaired by 25%. So 25% of the 20.
5.
So this is 5. So net goodwill there is 15. So let us do the goodwill of A and J. Or with the goodwill of A and J, A is an associate, J is a joint venture. That one, you don't even think of the method to use because obviously it's partial. So I can do it once. So goodwill of A and goodwill of J. So these are associates and joint ventures. Joint ventures is obvious, use the partial method. Because in an associates and joint venture, there is no element of NCI. The NCI is only under the subsidiary. So the subsidiary is the one which we think, which method am I going to use? Is this full or partial? When you have a subsidiary is when you think of the method to use. Of which I said in order to use the full, you must be given the fair value of non-controlling interest. That is the case of subsidiary. But for associates and joint ventures, there is no NCI. So you always use partial. So purchase consideration was, so I'm doing them once, that is concurrently, due to, so purchase consideration is for A and J. Cost of purchase. So cost of purchase here. So the cost of purchase, 200 and 250. So raise the net assets, share of net assets. So the share of net assets, remember that the net assets for A was 415, the other one is 440. And A was contract to 40%. So 40% of 415, then 50% of 440 for J. So 40% of 415, that is 100 and
166.
the 50% of this one is 220. This is direct. This is like a half of the nearly, or 440. So if you raise 200 minus 166,
34.
we have 34. And the 250. So this is 30. Then they were saying, so this is goodwill. And they say that we impair the goodwill arising from all the investee companies was impaired by which percentage? They said 25.
Yeah, 25.
So 25 of 34, 25% of 34, 8.5. And the other one is 7.5. 30% of that. So that their net goodwill will be so 34 minus answer. This is 25.5. And the other one is 30 minus 7.5, 22.5. So I was looking for impairment. So impairment to record now under the income statement as an expense is 5 plus 8.5 plus 7.5. So this one for S, this one for A, and this one for J. So that one will be 5 plus 8.5 plus 7.5. That one will be 21.
21.
So that one will be 21. So 21 is what to record. So that one will be 21. So give me the profit before interest and tax.
$527.
527.
So that is fine. So 527. So 527. So that, what about profit before tax? So the profit before tax, you take 527, you minus 50, add 28.5.4, not 5, then add 55.5.
560.9.
So this is 560 minus 110. For 60. So profit after tax here is what about 460.9. So that is for 60.9. So the only
450.
thing for 60 or for 50? For 50,
450.
Oh, so that is fine. So for 50, I would change this to 450 anyway. Yeah. So the only thing I need to determine is this one. I need to do a working. The profit attributable to the NCI. Then we get the profit attributable to parent. So in order to get the profit attributable to the NCI, so the profit attributable to NCI. So profit attributable to NCI. Profit attributable to NCI. So profit attributable to the NCI, you need to adjust the profit after tax in the subsidiary. So I was saying that for you to get this profit attributable now to the NCI, remember that we have this for 50.9. So this is what the parent has consolidated up to now from the associates, from the joint ventures, from the subsidiary. But remember that when he was consolidating his relevant item from the associates and joint ventures, it was very clear. He took 40% and 50% of that associate and joint venture after they have paid tax. He took 50% and 40%, which is fine. But as we have been adjusting, subsidiaries, for the subsidiaries, you can see we have not been taking 80% because the parent controlled it 80%. But we have been taking the whole amount, and that's what you are supposed to do until you get profit after tax. So we have been taking the whole amount of the parent and that of the subsidiary. So which means that the subsidiary has been taking the whole amount of the subsidiary. But you know that this subsidiary is never controlled 100%. The subsidiary was controlled up to 80%. So there's that 20% which was supposed to be attributable to the NCI. That is why we say profit attributable to NCI. Profit attributable to NCI. So you cannot say that after getting this profit after tax, we multiply with 20%. That's when you would be doing an incorrect computation. So what you do, you have to compute, you have to do an adjustment. You have to do an adjustment of the profit after tax, an adjustment of the profit after tax in subsidiary. So you have to adjust the profit after tax in the subsidiary. So that profit is either overstated or it was understated. That profit is either overstated or understated. So you have to raise UPS if sales upstream, if sales upstream. So sales upstream, that is you subtract. Then you have to raise depreciation. So you raise depreciation what? Under change. Then you add over change. You add the depreciation over change. So after adding depreciation over change, you have to raise impairment. You have to raise the impairment loss. So when you are adjusting the profit after tax in subsidiary, this profit, I'm raising UPS and here is profit on sale of fixed asset, not fixed asset, and here is profit on stock, not fixed asset, and here is profit on stock if sales upstream. Because if the subsidiary is the one who sold goods to the parent, then that parent never resold all the goods he received from this subsidiary. It means that the profit of the subsidiary is overstated by what the parent never realized, because the parent never resold all the goods he received from that subsidiary. So we raise. Then if there's an undercharge concerning depreciation, depreciation is an expense. If you understate it, if you are understating that expense, profit is more. So to correct that, you subtract. If there's a depreciation overcharge, it means that you understated the profit. So you add back. Then impairment loss you raise, because that is an expense which has not been adjusted in any manner. But for this to be applicable, we must have used the full method to compute goodwill. Because now the goodwill from full method is for the parent and this NCI. So profit after tax in subsidiary, profit after tax in S was, so the profit after tax in S was the profit after tax in S was which figure? 152.
Yes.
This one, eh? So 152. So that 152 is what is supposed to be adjusted. Was the sales upstream? It was understream because H is the one which was selling to H is the one which sold goods to S. That one was an understream. Was there depreciation undercharge? No, because there was no revaluation. What about overcharge? Was overcharge present? That one was present because there was this set of fixed assets. We got a depreciation overcharge of 8. Then when we were computing goodwill, so we used the full method, and the impairment loss was 5. That is concerning S. Remember, S is where we have NCI. We have the 5. So 152 plus 8 is 160. 160 minus 5, that is 155. So 155 is the profit we have adjusted. That is the adjusted profit. So NCI profit is equals to, so it was 20% times 155. So 20% was the NCI. So 20% of 155. So 31. So that is 31.
I don't believe.
Yes.
What do you mean by sales upstream?
Or sales upstream. So sales upstream, I mean, if the subsidiary is the one which was selling goods to the parent. So remember that when I say upstream, remember that H was controlling S. H is the one which acquired S and other companies. So when I mean upstream, if this S was selling goods to H, so it was sales upstream from the subsidiary to the parent. Downstream is what we say from the parent to the subsidiary. So if this one was selling goods here, remember that this profit was overstated. Was overstated because you will find that H has not resold all the goods received from S. So if it was an upstream, S sold goods here. Then on this side of H, he has not resold all the goods received from S. So you will find that this profit of S will be overstated by what the parent never realized because he never resold all the goods he received from S. Is that fine?
Yeah, thank you.
That is how we adjust. That is how we adjust the profit. So after getting that, you multiply with the NCI percentage to get the profit attributable to NCI. So that the balance of 450 minus 31 goes to the parent now. So out of 450.9, 31 is going to the NCI. So the balance of 419.9 goes to the parent. And that is the end of the income statement. And that opens the next requirement, which concerns the statement of financial position. Any questions so far?
I have a question.
Mm-hmm.
On revenue, why did we ignore the sales on fixed assets? Intergroup sale on fixed assets.
When did it occur?
1st May 2010.
Was that between the current year?
No.
That is why.
But we went ahead and calculated the
UPFA is okay.
okay.
That one would obviously affect your PP and profit. But for you to subtract it under revenue, the only intergroup sales you subtract there is the one which occurred in the current year under consideration. The sales which occurred in the current year under consideration.
Okay.
Yes, the other things which arises from there, like now UPFA, that one you have to compute. It will affect your profit. Because obviously, even other profits, we have the profits which we need to carry forward from the previous periods, which are adjusted in the current year. I think that is fine. So the only intergroup sales you raise under revenue is the one which was in the current year under consideration, and it occurred between the parent and
Subsidiary.
So we have to talk about H limited, but this one seems H limited. So consolidated statement of financial position. I will write in short. Consolidated statement of financial position. So for the year, not for the year, but as at. So anyway, for the years when we talk about the income statement. So let me change that one. So you always prepare an income statement for the year, but a statement of financial position is prepared as at the end. So saying for the year, that would be incorrect. So H limited. So consolidated statement of financial position. So consolidated statement of financial position. So that is as at. Our financial was ending on 30th April. So 30th April 2012. So we start from PPE, which is non-current assets. So non-current assets, we talk about PPE. So PPE is the parent plus subsidiaries. So 1250 plus 800. You add revaluation if it was present, because revaluation increases the value of this asset. Then after revaluation, you are supposed to minus depreciation undercharge. Depreciation undercharge is due to this revaluation. Then after that, you minus 40, which is UPFA, you add 8. But now the 8 you add must be for 2 years, because it's accumulated from the time of so right now I have added revaluation. Revaluation was not there. Revaluation increases the value of the asset. If it was there, you add. Depreciation undercharge, you subtract, because you never charge depreciation on that relevant asset. That's why we subtract. Then UPFA you minus, and here is profit on fixed asset, which is equals to transfer value times profit margin. Then depreciation overcharge you add. Depreciation overcharge you add. So depreciation overcharge, remember, depreciation overcharge was concerning an asset which was sold in the year 2010. And the 2010 to the current year, how many years are those? Because this additional information number 4, they said on 1st May 2010, H sold as an item of plant for 200, reporting a profit of 25% on initial cost. 2010. So from 1st May 2010 to the current year, which is ending 2012, those are 2 years. So accumulated, so the depreciation must be accumulated. That is why I'm multiplying with 2, the 8. So then we move to the intangible assets. Intangible assets is direct. We add parent plus subsidiary, so 200 plus 120. Then we have goodwill. Goodwill we introduce. So let me explain something here. So you can see under this statement, we have started this way. PP, we have taken parent plus subsidiary. We have adjusted. In intangible assets, parent plus subsidiary, we adjust, but there was no adjustments for intangible. Then the third thing here you see is investments. So investments of 850. So this investment was made in S, A, and J. So you don't have to write investments for S. You replace it with goodwill. Then investments for A and J, we need to use the equity method to account for those associates and joint ventures. So that will be fine. So for the associates and joint ventures, I need to record investment in associates, and I need to record the investment in joint venture. Investment in joint venture. So this one will be done as a working rate. Goodwill for, remember the goodwill is for S. This one is for A, and this one is for J. So that is how you record that investment in 3 ways. That is how you record the investment in 3 ways. Of which investment in associate and joint venture, I've said, you use the equity method to get that. But goodwill for S, I remember we got goodwill for S was it 15? So this one was 15. So for this and this, we need to do working using the equity method. I will show you. So the equity method is the one which you use to account for associates and joint venture. So then we have current assets. So for the current assets, we have the inventory. So inventory, that is 200 plus 75, parent plus subsidiary. You minus UPS, and here is profit on stock. You add goods in transit. So goods in transit is whereby if there was some goods which were being sold by the one entity to the other, and that other entity which was supposed to receive them never received those goods by the end of the year. He received those goods some days after the end of the financial year. So remember that once he received those goods, he has to increase his stock, the group inventory account. The group inventory account. So this is UPS. So for receivables, already I explained this. So I have to take parent plus subsidiary from the statement. Then after that, I need to minus 40, minus 10. Then I have to record here financial assets. So financial assets at fair value. Financial assets at fair value. So the financial assets at fair value is concerning 30 plus 20. That one was direct. Then cash. So cash and bank my marker pens, I think I need to add ink, but that one will be done later. So for now, let's continue. So for bank, is 150 plus 40 plus the 10. So where is this 40, 10, and this 10? 40 was the one amount which was outstanding. Remember that the 40 and 10 I have subtracted there is the amount which was outstanding between the parent and the subsidiaries. And it was never paid by the end of the year. It was here in note 6. Included in trade and other receivables and trade and other payables are outstanding balances due from S to H. I said 50. So the others for A and J, those are irrelevant. But they said down here in the books of S, the amount due to H was shown as 40 instead of 50. Why is there a difference of 10? S had sent a check of 10, but H had not recorded the check. So which means that 10 was on transit. So 10 has been paid, it was on transit. So I have to reduce the 10 under receivables and I will add it to bank or cash. So the 40 is the one which was outstanding. I said we cancel out by again subtracting under receivables. And when I would be coming to payable, I would subtract this 40. That is why you see after taking the parent transactions and the subsidiaries, I'm adjusting those items. For the others are direct, like financial assets at fair value, it's just direct, parent plus subsidiary. Inventory, have taken parent plus subsidiary. You minus UPS, you add goods in transit. That one I've explained. So up to this point, you are supposed to get total assets. So after getting total assets, you talk about equity. We talk about equity and liabilities. So for the equities and liabilities, you remember this one is again more direct because like now ordinary share capital is that of the parent. Share premium, you pick the one for the parent only because the one for investing companies have been used in the computation of goodwill. So ordinary share capital of the parent is 1,000. Share premium of the parent is 300. Then what requires working is revaluation reserve. Revaluation reserve needs a working. Retained profit need a working. Then you will introduce here NCI. That is non-controlling interest. So the NCI. So these items I've recorded, they are just from the statement, direct. They are from the statement, direct. Like now, ordinary share capital, I've said you go with the figure of the parent. The column of the parent, we have 1,000 there. Share premium is this 300. But now revaluation reserve, I need a working. Retained profit, I need a working. Then I have to introduce NCI here, which is not there. So in order to determine what was the capital of the NCI in that S, then the others, 10% loan stock, I would take 400 plus 200 minus 100. Because now under this 200 of S, H had invested a half. This a half of 200 was part of the investment. You were told that in additional information number 2 there. Or it's additional information number 1. You were told here. H also invested in a half of the 10% loan stock. So when I will be consolidating this 10% loan stock, I will take 400 plus 200 minus 100, the investment. Deferred tax is direct. 100 plus 50. Trade payables is direct, but I need to adjust 2 items there. That owings of 40, then I will add goods in transit. So trade receivables, remember by trade payables and trade receivables. So on trade receivables, I said you subtract the 40, the owings. Then under trade payables, again, you subtract the 40, which was an owing. That is how you cancel it out, so that nobody will be owing another entity in the next financial year. So that if the goods again, which were sold and were on transit, were on credit, the goods in transit, the one which has not been received by the other entity, if they were on credit, remember they have to increase our trade payables. If they were on credit, you have to record here. They have to increase the payables because it was an amount of goods which were sold and were on credit. Then current tax is direct. So I think now I can record. So the other thing which was remaining is just the one I've talked about right now, non-current liabilities. So for the non-current liabilities, we are supposed to take 10% loan stock. So 10% loan stock, that one is 400 plus 200. So minus the 100. A half of this was part of the investment. So that is what I'm subtracting there. Then deferred tax. So deferred tax is direct, 100 plus 50. So current liabilities. So for the current liabilities, you have to take trade payables. So the trade payables, that is 250 plus 200. So I said you minus the 40, which was outstanding. So the one which we had already subtracted under receivables, that is how we cancel it out. Then if the goods which were on transit were on credit, we need to add them here. If they were on credit. So and remember that we added it under stock, under inventory, goods in transit, because now they will be received by the entity which was intended to receive them. So once that entity will receive, it will do what? It will increase the group inventory account. So current tax. So for the current tax, that one is direct, 20 plus 20. So up to that point, we are done. So we can be able to get some of these things. Here is 40. 250 plus 200, that is 450. 450 minus 40, that is 410. This one is 150. 400 plus 200, 600 minus 100, 500. So the other items here, they does not require a calculator. 150 for the bank, that is cash and bank. This is 190, 200. Then this is 50. 390 minus 40 minus 10. That is 340. 270 plus 75, that is 275 minus 15. This is 260. So the first one you can calculate because there is a 16 there. So 1250 plus 800 minus 40 plus 16. This is 20, 26. Then this is all about 320 for the intangibles. So we have around 4 workings to do. So you have 4 workings to do. And for an exam situation, I think you have the entire mark. It is even exceeding the marks which is required. This is around more than 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So statement of financial position was requiring how many marks? They required how many marks? Are you there, guys?
Yeah, we are. But I can't see the paper command.
Or you don't have the... See, I shared this paper. So income statement, because I have the hard copy here, the income statement, this one was 10 marks. Then the statement of financial position was 10 marks. You can see our points are exceeding 10 for statement of financial position, even before the workings. So when they mark the exam, they mark one entry for 1 mark, one correct entry for 1 mark. So if you could have scored that way, there's no even need of doing workings. In an exam situation, there's no need for you to do those workings. You will be wasting your time because already you have the entire mark. It's not a must that in an exam situation you get, like now in consolidation, you will find sometimes the entries are exceeding. Entries are exceeding the required marks. So they will mark until where you get the maximum points. So what they require, 10. So correct 10 entries for statement of financial position, you get 10. Correct 10 entries for income statement, you get 10. That's all, even if you don't balance the question. So for now, the understanding purpose, let us do the 4 workings. Then we can call it a lesson for today. So let us start with the first one, that is investment in associate and joint venture. Investment in associate and joint venture. So we use the equity method to do the 2. We use the equity method to compute the 2. So which I have A and I have J. So you first measure the associate with the initial cost. So initial cost of investment was? So the initial cost of investment, the initial purchase, that is a purchase consideration. The initial purchase consideration was? So this one here, cost of purchase, 200 and 250 for A and J. So what you do, you add share of post-acquisition, share of post-acquisition, profit or reserve, share of post-acquisition profit stroke reserve. So share post-acquisition profit. So we start from retained profit. We start from retained profit, post-acquisition. So remember that we have A and J. Then the same we will do with revaluation reserve. So revaluation reserve, again, we have A and J. But remember, it's post-acquisition. Then we raise impairment. So this is the format. We raise impairment loss for A and J. This one you will be given direct. Not you will be given direct because we have computed goodwill and we have it. For impairment, we already have it. So this one, remember A was 40%. This is 50%. The same here, 40%, the share, and 50% of the post acquisition. So in order to get the post, you always take, you go to your statement of financial position. You go to your statement of financial position. So the retained profit as at the end of the year was, remember that the statement of financial position is prepared as at the end of the year. So this statement is prepared as at 30th April 2012. So the transactions which are here is as at the end of the year. So the retained profit as at the end, like now for A was 200, and for J this is 280, not 780. This is 280. So these are the relevant retained earnings at the end. So in order to get post-acquisition retained earnings, so you take these balances, you minus the one which you were given as at the time when these entities were acquired. Like now for A, you will pick the one which is here at the end. You minus the retained earnings which was given as at the time when A was acquired. So when A was acquired, as at 1st May 2008, 2009, not 2008, as at 1st May 2009, the retained profit was 150. You are given in the last column there. For J was 120. So you take the balance carried down, you minus the balance as acquisition date. That is how you get the post. So which means like now this is 200 minus 150. So 200 is the balance as at the end of the year. Then 150 was as at acquisition. The same you do with the J. Carry down was 280, as acquisition was 120. Because obviously I'm subtracting this 150 and 120 from these balances, because this 150 was inside this 200. And this 120 was inside 280. So you have to subtract to get the post-acquisition retained earnings. Because as at the time of acquisition, we have 150 and 120 here. By the end of the year, we have 200 and 280. So to get the post, you have to subtract that which was present as acquisition, which by the end of the current year, those 150 and 120 is inside this 200 and 280. So you do the same for revaluation. You do the same. So carry down was 50 here. Then as acquisition was 15. Then the other one was 50 and the 20. So these ones 50-50 are from the statement of financial position. Then 15 and 20 are additional information number 1, as at the time of acquisition. Impairment, I remember we got 8.5 and 7.5 when we were doing goodwill. When we were doing goodwill. That is fine. So give me the answers for retained profit for A and J. So if I take 50, so 0.4 times 50, so this is 20. Then 280 minus 120, that is which amount? 160. 160 times 0.5. This is 80. Yeah? 50 minus 15 times 0.4. This is 14. Eh? Then 30, so this is 15. Eh? So you do the computation, you get net investment. So 200 plus 20 plus 14 minus 8.5. 225.5. Eh? 250 plus 80 plus 15 minus 7.5. 337.
0.5.
337.5. So that is what you record. That is what you record as your investment in associates for A and J. So 225.5. Then here we have 337.5. So let us do the rest two. This and this. Revaluation reserve and retained profit. So for the revaluation reserve, you need to do a T account. So you have also, we have the NCI. So the third one would be the NCI. So the revaluation reserve, you pick H and S. So the revaluation reserve of H and S from the statement of financial position was that one of the parent and that one of the subsidiary. So this revaluation reserve, this of the parent and the subsidiary here, 250.
250.
So 200 and this 50. So what you do, remember that the NCI was inside that S. Before I record that NCI on the debit side, I need to consider your post-acquisition revaluation, of A and J. Because I've considered the breakdown of H and S, so I have to add post-acquisition of A and J. Post-acquisition of A and J is this one, 14 and 15. Then I've said under this S, there's an NCI of 20% of that 50. So that one is 10. Then finally now we have to consider the post-acquisition revaluation of the post-acquisition revaluation of S. This one is not post, but pre-acquisition. Sorry for that. So this is where we have considered post. So we have to consider pre-acquisition. Pre-acquisition of S. So pre-acquisition, I mean as at the time of acquisition of S. Pre-acquisition means as at the time of acquisition of S, the revaluation reserve was The revaluation reserve, this one you are given here, note 1. As at 1st May 28, this column of revaluation reserve, you can see we have 20. For A and J, we have taken post. So for S, you have to take pre. But remember, it was controlled up to 80%. So 80% of that 20 as at the time of acquisition. So that one you get 16, because 8 times 2 is 16. So the balancing figure is, so 200 plus 50 plus 14 plus 15. So this one is 279. So here is 279. So which means that minus 16, minus 26, not 16, minus 26. I get 253. So these are about the balancing figure here. 253. And that is what you record here. Let us do the last two items. So we have NCI and retained earnings. NCI and retained earnings. So for the NCI, you have to open a T account. Whereby on the credit side, you would have net assets like ordinary share capital, share premium. I remember there was retained earnings and there was revaluation reserve. So this one you pick direct from the statement of financial position. You multiply with 20% because 20% is the NCI. Remember the parent acquired S up to 80. So we have 20% under this, which is an NCI. So we have 20% there, which is an NCI. So you pick the items direct from the statement of financial position. That concerning the net assets of S. So it means you copy this. We have 200, 50, 50, 375. So this one you pick direct from here. So which means that this is 200, 50, 50, 375. Then you come and record goodwill of the NCI. So goodwill of the NCI was, I remember very well, it was 4. Remember we computed the goodwill of, when we computed the goodwill of which company? We computed the goodwill of S. So the time when we computed the goodwill of S, we got the goodwill which was going to the parent and the one which was going to the NCI. So the one which was going to the NCI was 4. The one which was attributable to the parent was 16. Do you remember that?
Yes.
Aye. So that one you record direct. Then what about depreciation overcharge? Our depreciation overcharge was 8, but I said it must be cumulative for the statement of financial position. That depreciation, when you are recording it under the statement of financial position, it must be cumulative. For the income statement, it's just for the year. So that's why I only adjusted 8, but here I have to adjust 16 for 2 years. Remember the 8 arised from the sale of fixed asset, which was sold on 1st May 2010. So from that period to the current year is 2 years. So this is 3.2. So this was 40. This is 10. This is 10. So 0.2 times 375, that is 75. That is what we record under the credit side. Then the debit side. So since we have a depreciation overcharge here we have an undercharge, including UPS. But if sale is an upstream, if the sale is upstream, if the sale was from a subsidiary to the parent, if the sales of goods occurred from the subsidiary to the parent, it was a downstream. So including depreciation undercharge, so depreciation undercharge. So there was no depreciation undercharge. Then finally we have to record impairment. So impairment loss. And for this one to be applicable, we must have used the full method, of which we used the full method. When we were computing the goodwill of S, we used the full method. The impairment was 5. So 20% of 5. So check the impairment of S, the goodwill of S. So this one is 1. So if you add 40 plus 10 plus 10, that is 60. 60 plus 75. 60 plus 75 plus 7.2. I'm getting 142.2. So 142.2, which means that my balancing figure here would be 141.2. 141.2. So 141.2 is what you record as your NCI. So 141.2. Then finally, the last working concerns retained profit. So retained profit, you do the same as the statement of changes in equity. This is the same as statement of changes in equity. Same as statement of changes in equity. I'm calling it statement of changes in equity in short, this way. Statement of changes in equity. So what you prepare there is the same as statement of changes in equity, of which you start with retained profit balance brought down. So for all the companies you have, H, S, and A, and we have J, then you add retained profit, you add your retained profit balance brought down. Retained profit, not balance brought down. Balance brought down already I've recorded. So this one, it's like now I'm getting tired when I start recording that way. So you add profit attributable. So you record profit attributable. Profit attributable to parent. Profit attributable to parent. So you add the profit attributable to parent. So this is profit attributable. Attributable to parent. So profit attributable to parent, this is when it's added. Then what you rest is concerning dividends paid. Dividends paid by the parent. So profit attributable to parent was from the income statement. You got which figure? There's that income statement we did. There's that profit we got, which was attributable to parent, this one. 419. Profit after getting profit after tax of 450.9. Profit attributable to NCI we computed, we got at 1. The balance was going to the parent, 419.9. So what about dividends paid by the parent? That one was direct from the question. You go to the income statement, you check dividends paid by the parent. So the dividends which were paid by the parents here was concerning 50. So that is fine. So the dividends paid by the parent, this one was 50. This, under the column of the parent. Under the column of the parent. So that's 50. Then now, what is the balance brought forward for H? Let's start even S. Let's start with J. So this one was control up to 50. This one is 40. And this one is 80. So balance brought forward for S, A, and J. Let's start from J. So to get the correct balance brought forward for J, remember there's that one you are given here, which is a retained profit brought forward. This one, like now, the one for J, the last column there is 209. That one is the brought forward. But remember when the J was acquired as at 2008, there was some retained profit which was there of so S Limited, it was acquired, not S, but J. J was acquired on 2010, which is fine. S is the one which was acquired on 20. So J was acquired 2010, 1st May 2010. So as at that time of acquisition, we have a 120 retained profit, which is inside this balance brought forward of the current year. So to get the correct retained profit brought forward for the current year, you have to take this 209, you minus the one which was there as acquisition date. So I mean 209 minus. So this is the correct, this is the balance we are given, but the one as at acquisition as at 2010 of 120, we have to subtract. We have to subtract so that we get the correct retained earnings for the current year. Because that 120, you will find that it's in the current year inside this 209. When we are starting the current year, this 120 was inside this 209. That is why we subtract to get the correct retained profit brought forward for the current year. So you will do the same. Like now, this one we were given 159 brought forward. You minus the one which was as at acquisition, 150. This one was 273. You minus 85. Then this one was 445. Then there's something here we need to adjust under H and S. So under H and S, there was that fixed asset which was sold between the two of them. H sold a fixed asset to S. So which means that H, when H was selling the fixed asset to S, he realized a profit. But I said that this S will never resell that fixed asset. So which means that the profit of H is overstated by what the S would never realize. So it means that to avoid profit overstatement, we have to subtract that profit which was never realized, UPFA of 40, in order to avoid this profit from being overstated. Out of the intergroup sales of these fixed assets, both of them charge depreciation. So we have to correct by adding back in one side, so that we bring the profit to its normal state. Depreciation overcharge was 8. I will add it under one of the entity, because both of them they charged. So I have to return back one of the depreciation overcharge of 8. So 445 minus 40, that is 405. Then the other one, 273 minus 85 plus 8. You multiply with 0.8. So this is 156.8. Then 150 minus, so 159 minus 150, that is 9. So 0.4 times 9. So this is 3.6. Then 209 minus 120. 209 minus 120 times 0.5. So this is 44.5. So remember, this is subtracted. So if you compute, so what is the retained profit carried down, or retained earnings balance carried down? So we take 405 plus 156.8 plus 3.6 plus 44, 44.5 plus 419.9. What is the answer you getting?
1019.8.
1019.8. Confirm again.
1019.8.
Rowan, are you getting the same?
No, I have
Sorry.
979.8.
Yes, 970. So Elizabeth, you need to check. 970.
9.8.
979.8. 979.8. So that is what you were supposed to record as your retained profit. 979.8. So remember, 50 you subtract. Maybe you added that 50, Elizabeth.
Yeah, I've seen where I've gone wrong. I have corrected.
So that is 979. So you recorded there 979.8, as I have recorded. So check if the question is balanced so that we can be able to finish. Because now even you can start feeling the background noise. So anyway, let us finish. So balance the question. Assets. So if you add the assets, 2026 plus 320 plus 15 plus 225.5 plus 337.5 plus 260 plus 340 plus 50 plus 200. What are you getting, guys? 37?
37.74.
37.74. What about equity and liabilities? Let us add 1,000 plus 300, that is 1,300, plus 253, plus 979.8, plus 141.2. So you continue with the non-current liabilities on the other side there. 500 plus 150 plus 410 plus 40. I think it's the same. Eh?
Yeah, it's the same.
Yeah. So 37.74. And that is how you were supposed to say that the question is over. And you have your good 20 marks. Yes, but you can have the 20 marks even without doing all the work we have done. I think I explained on how to get the 20 marks first. Let's say it was an exam situation. I think you understand on how to do it. Do the postables first before you think of doing those workings and so on. Because we know how they mark these things. We have been there for some time. So you can have a nice time. If there's a question, you can put a close. And for the other online guys, also you are welcome to join this online session. And also you can encourage your friends to join these Zoom classes. So nice time.